Daily dividends, 13% yield. Is it worth the risk for your retirement account? Hey everybody, welcome back to the channel. I'm Doug, the retirement guy, with all your monthly and now daily dividend ETF needs. So this one came across, I've already done a video on this one before, so it's not brand new to me. I just want to give you guys more information because it's starting to pop up on the chat boxes again, and I'm like, okay, time to give you guys some more insight. Essentially, it's got some time underneath it. So grab your favorite mug, fill it with your favorite beverage, sit back, and let's learn about this new daily dividend 13% yield and see if it fits in our retirement packages. So disclosure, this presentation is for entertainment purposes only. It's not financial, legal, or tax advice. Past performances do not guarantee future results. If you need professional help, always contact a professional financial advisor. Hey, I wanted to make an announcement to you here. The new book, it is arrived. It is on the shelves. It's ready to go. Living on Dividends, the 3-bucket system. That's right. I took the time when I was on vacation doing different things. We got down writing and we put it together. The freedom, the income, the peace of mind of living on dividends, the 3-bucket retirement system book. It's a strong little piece. It explains everything about the 3-bucket system, how to set it up, has a worksheet in it, has everything you need. So use the QR code, use the links down below. You can get it at Amazon. You can do it in Kindle. So if you have a Kindle, you can download it in the Kindle. You can get that, or you can order it directly from myself through the website with all the cups and the mugs and the license plates and everything else that I have for living on dividends. And if you order it directly from me, you're going to get it autographed and directly mailed off to you. The other ones, unfortunately, I can't do it because they're going to direct ship you. So wherever you want to buy your favorite books at, don't be afraid. I'll be around there. We'll be there to do it. But this is one of the best things I haven't done yet. I'm excited about it. So hopefully you'll support the channel and do that. So what are we talking about? And that's going to be Strive. SATA. Now this is not, I want to be right up front with you. And this really is not an ETF. So I probably will say it throughout the program, but this is not an ETF. Okay. So don't buy the payout without understanding the risk. Again, biggest thing I talk about on this channel is don't chase that 13% yield because, wow, that's huge numbers and we're all set and grab it and go. You got to know the risk behind it. Now, I personally have invested in this. I've owned it. I've been down the rocky road, which I'll show you here shortly. I've been down the road. I've been back up. So it's one of these things that, again, with not being an ETF, but it is an income-focused preferred stock. So an income-focused ETF commonly used for high yields are structured as a registered funds that pool investors' capital together and go after market segments like the S&P 500, NASDAQ, Russell. And then they use covered calls or overlays or anything like that to generate income, and it regulates the pool investment as the vehicle. Now, the SATA preferred stock is a direct preferred equity issued by Strive, is a corporate security, not an ETF, and is a traditional dividend stock. So there's no option overlays. There's investors own the shares, and it pays out, depends on the corporate financial health. So right there, we got a lot of differences between these two. You actually have ownership in this company. You own shares of this company. So you're counting on the corporate financial health to pay you out. So exactly what is SATA? Well, SATA is a preferred stock issued by Strive. Unlike common stock, it represents a layer of capital that typically prioritizes income distributions over growth. It is an investment in an issuer financial strength, not a direct ownership or underlying index or commodity. Okay? So I think I've clarified that again across the board that you are actually buying shares of Strive. Okay, you're buying that. You're buying, the common stocks of this. You're not buying an index. You're not buying anything. So whatever the company does is what you're involved into, and what they change to, you're involved into. So the evaluation of the payouts, and I think they did this for a reason, is, and on their website they'll show to you that they say they are the daily payout company. And I think they jumped onto that because of what was going on. We went from quarterlies to monthlies. And monthlies were really started off with the REITs. The REITs is what started the monthly tradition because people were paying rent every month. So they wanted to create a ETF that paid you every month. So then we got to very comfortable, and we do a lot of these on the channel, monthly ETFs. Then they started out with weeklies. So they started this high yield income fashion of weeklies. Well, STA came out and said, hold it, we can do it one better, and we did dailies. So it's a rare income structure. It's designed for that daily liquidity and signaling of the fund. So frequency is not the same as safety. I want you guys to be very clear with this. You always need to know, where does the money come from? I don't care if you pay yearly, quarterly, monthly, weekly, bi-weekly, daily, whatever you want to do. You got to know where the money is actually coming from. So the yield and daily payments, this thing is here. You have an annualized dividend rate of 13%. Now, what I really want to show here, it doesn't much matter if it's an annual payout, a monthly payout, weekly payout, daily payout. It's $13 if you do annually. It's $1.08 if you do monthly. It's 25 cents if you do weekly. It's 3.5 cents if you're doing it daily. So I don't see the daily being that big of a thing. I think it's just an eye catcher is what they're trying to do. Now, is there a little bit of that you can roll the stuff and get some extra yield out of it? Yeah, but you're talking such minor amounts, so I can't say that. So that's why I say the economic reality is it's the same annual math. I'm a simple math guy. It's the same annual math, when you receive the cash at once a year or daily. The delivery mechanism, that daily, is frequency a choice. It's not inherent increasing the safety or the reliability of the asset. And compounding potential, that compounding is so small that I talked to before. It supports that faster reinvestment drip, but only if the share price remains stable. So the real test is sustainability. Can the issuer maintain that 13%? Is the principal stable? Does it hold that $100 share price target that they try to do? So what we got to take a look at next is, let's take a look at the dividends. Let's take the actual look at the dividends. And you can see they've been basically paying about 5 cents per day. And when they started this program, so this is not a brand new fund. It's not like they just started it and here we go. They were paying basically, I believe it was right around monthly prior to. And then mid-June is when they started making that daily type thing. So they're about 5 cents for dividends, 5 cents per day. Now let's take a look at the growth year to date. Now there's two major drop-offs. And you can see that, what we say, these are huge drop-offs. These are 10, 12% drops. So right now, the price is actually up 5.16%. So I'm not going to tell you that this is a growth fund. This is more of a stable, it's going to stay in that $100 range, but you see when it drops dramatically. And it has a lot of things behind it, which I'm going to talk about, which, Bitcoin is a major part of this because they're a Bitcoin processor. But you look at right now, in the June, we had a huge drop off in June. We had an early one in early July. We've recovered. So it does have the ability to recover. But I really want to say this is not designed as a growth fund, even though we're showing a 5% year-to-date positive number. It's just you got to buy I'll say this, as I told you, I own this, and it's one of these things that you need to buy on the drops, on those drop offs, those dips. You got to buy at the dips is when you want to do this, to be safe. Now, total return, 13.79%. So what does that tell you? 13% yield, 13% year-to-date total return. So we're right in track that this is probably, if things stay where they're at, you're probably looking at a 13% yield with a 5% growth about. But I'm telling you right now, the growth is not going to be, I would not count growth as a part of it. As long as this number stays above 13, you're probably okay with a 13% dividend. So here's the question I had before and told you is the Bitcoin connection. The issuer balance sheet, SATA holders, do not own Bitcoin directly. Instead, the Strive company raises capital through preferred shares and develops it into a corporate strategy, which includes significant Bitcoin exposure. So this is one of those pieces that if Bitcoin drops off, which is probably why we see the two huge drops, if Bitcoin has a drop, this is probably going to have a drop. The question is, can it recover? How can they recover? Where does it recover from? The financial position link, the financial strength backing SATA is tied to Strive's health. A Bitcoin bull market potential strengthens the issuer's position, while a bear market could weaken the backdrop for preferred shares. So the risk is SATA shares are not designed to move one-to-one with the Bitcoin price, but the issuer's ability to maintain distributions depends on the financial flexibility influenced by the Bitcoin market. So this is not, it's an indirect risk, it's an indirect connection with Bitcoin, but Bitcoin's going to play a big part of this. So the big risk is that capital inflows and sustainable. Now, SATA is not self-sustained machine. Distribution stability depends on the health of the issuer and the investment demand. The new capital inflows provide Strive with the necessary financial flexibility to manage its corporate strategy and prefer shares obligations. Now, I've looked at their things and they said they have cash for 20 plus years to pay out these type of dividends. That's phenomenal having that much cash flow on hand. So that's what they're trying to make sure they're showing you the risk factors. They have a ton of money on hand, but you never know if that money is actually going to, will it be there to pay it? So it is a risk factor still, even though they say 20 years. Well, you don't know in 20 years from now how many people have invested, what's going on. So the active monitoring of the dashboard is this, the issuer. You need to watch the financial position of Strive, the overall balance sheet, the liquidity, and the support of that distribution. Bitcoin price involvement. If you see the Bitcoin volatility impact Strive's corporate financial strength, so if you see Bitcoin dropping off, Strive's probably going to be down. So it tells you what's going on. Follow what Bitcoin's doing. The investor capital demand, track the net inflows into STA. The substantial demand is critical for distribution flexibility. And at dividend coverage, verify that the 13% annual rate remains consistent through their earning powers. So what's going to be the job, or not, like I said, not primarily growth, but what's the job of SDAs, and that's income. The income mandate, so $100 is design target price. They're trying to do everything they can to keep that price at $100. It's designed to maintain relative price stability near its issuer target. The premium objective is the high frequency distribution, those daily payments, to get into that 13% yield. Now, like I said, the growth engine, I don't see growth engine being there. Okay, that's not intended to climb from $100 to $200. Even if Bitcoin takes off and rockets, I don't see this doing it. It's the fundamental different from owning Bitcoin or QQQ for direct growth. This is just a income-based driving piece. What happens if it falls below $100? Well, again, SATA is designed to trade close to that $100 price. However, market conditions and risk percentages can cause the share price to fluctuate. Understanding the difference between a buying opportunity and a risk signal is critical. You've seen my chart before. You've seen two big drops. Those were, to me, were risk points. But realistically, they were buying points. So buying below $100 mathematically improves the yield on your investment capital, assuming that the dividend remains stable. So if you're purchasing at $90, you're technically up to a 14.4% yield. So it improves your yield on cost for the new capital, potential for capital recovery back to $100. So the price significantly below $100 may indicate that the market is discounting genuine underlying risks. So the issuer strength, the Bitcoin volatility, the equity trap, and the sustainability, you really got to stay focused on this one. This is why I question for retirees if this should be in your portfolio or not. The dividend, the daily dividend, the marketing, and the real benefit, like I told you. The marketing is, oh, we're doing it daily. And people jump onto it. And they're all like, wow, this is great. But the critical decision is what is the total return? As long as if that thing stays above that 13%, I'm happy. We're content. How is the stable in the principal? I've watched it. That it does drop between that $90 and $100 price range. So if you're going to buy on the low. Is the distribution sustainable? Where does the cash come from? Is it earnings versus capital? And that comes from their stock reports. And what happens in the bear market? Well, I don't know if it's really structured that, to react to the decline of Bitcoin, that if the Bitcoin goes down, this is going to go down. I don't think they have a security side of it. And how much risk is taken? Does the yield justify the issuer of assets exposure? A lot of people have asked me, should we drip this? Well, I have no fear dripping on this. It's going to be a slow drip, I will tell you that. It's just a slow drip across the board. But daily dividends create a visual, powerful compounding effect, allowing cash to be reinvested continuously. So the immediate liquid development into additional preferred shares, the powerful over long-term holding periods, the price stable things. If you're going to drip, you're going to be in for the long haul. I just tell you that up front. The active monitoring is what you really have to do in this. Reinvestment is a buying decision every single day. It's not just a set and go. You got risks that you got to worry about. You got added money to be declining into the asset. So I'm more of a person of buy on the drops versus buying on the, on a drip type situation. So when you saw the thing drop 12% down, once that thing started to make a recovery, I could see you buying back into it, limited amounts. Now, could you retire? This was actually a question I got from a viewer, and he said, could you retire on SATA? And I kind of chuckle and laugh, and the answer technically is yes, but why? If you get that point, yes, you can with 13%. I mean, I got the numbers right here. If you needed $13,000 to cover your income gap, $100,000 to do it. If you need 32.5 income gap, 250,000 can do it. If you need $65,000 a year, $500,000 could do it. That 13% number is what's doing it for you. But here's the thing, it's not a guaranteed paycheck. You don't know what your cash flow is going to be. You don't know the payment frequency. They could stop paying, guys. This is not a guarantee. So I would not build my retirement plan around a single high yield security. That's why I do that 3-bucket system and promote that 3-bucket system as I do. So who might this be for? Well, if you want some Bitcoin awareness, this could be your little baby to put that into it. Not getting into Bitcoin, but using things around the Bitcoin side. If you're currently an income seeker and looking for the extra boost, that 13% could give you that nice boost in the fund. You're not expecting any growth. Active engagement. This is not a buy it, set it and forget it asset. You don't want to work. You don't want that. You want to be active in watching this across the board, and you got to know your risk. So if you're talking about monitoring and the 3 bucket placement, what do we need to do? Let's get to the hardcore parts to this. First off, the critical monitoring metrics. You want to watch the dividend rate. I've seen this one to where it was climbing and then they made a cut in the distributions, and now they brought it back. So they're going to make adjustments to keep it at 13% or less. Okay. The share price stability, you want to watch how long can it hold at that $100 price point. And I think $100 price point, truthfully, if you're buying into it, is too high. That's the top end. You want to buy at the low end. The Bitcoin exposure and issuer strength. Stride's financial position is relative to the Bitcoin market. So if we're going to see Bitcoin cycling through again, then they're probably going to be in that game. You're going to see some operations to it. Investor demand, we want to see new capital going in. You want to see the assets under management growing. If you're seeing that, okay. And then you want to watch your total returns. And personally, guys, this is not a promotion. I don't do the promotions onto it, but I use Seeking Alpha, or excuse me, Seeking. I do use Seeking Alpha. I'm sorry. We've got a storm coming in. That's what's throwing me off. I do use Seeking Alpha. I also use stock analysis for a quicker, faster grab, just to see what it is. Like sit there at night and just say, what did they do today? For a portfolio, the 3 bucket system. Now, a lot of people have asked me, would you put this in your foundation? And, I put up here, no, but that's it. I would not argue with somebody if they put a little bit of cash into it. I would not put all your money into it. I'd put maybe some cash to generate that 13% additional to it. But if you're not putting a lot of cash into it, the dollars and cents don't make the difference to the risk. Monitoring for the income, this goes into my final bucket, the income bucket, but in the final category after your NASDAQ, after your S&P, after your Russell, after your either international or REITs or anything like that. It's just a no more than a 5% total package into it. I don't think this is something you want to put big total money into across the board. Long-term growth, man, this doesn't fit in a 3rd bucket. So realistically, I think this is maybe a number 1, maybe a number 2 placement. But if you're putting in number 1, you gotta make sure it's extra money you're putting in, not nothing that just say is like you're going to the casino, you could lose it tomorrow. So that's how I would do it. I know I put on here not a foundation bucket holding, but it's a piece that you could put in there, but it's not a holding, which means you're not looking at that first. It's cash, treasury, high quality bonds, all of that side of it, and then anything extra that you can see that you don't going forward. So the bottom line, it's a frequency to safety, Bitcoin structure, price objective, portfolio placement. This is an interesting piece. I personally own it. I got into it to try it out, to just see. I know the daily was interesting to me. I did have some extra cash. I wanted to try into it. I've seen it go down. I've seen it come back. But it's not enough to move my needle for my income. It's just some extra fun play money too. So let me know how you guys would use it. If any of you are using it, tell me how you're using it, where it's at. Some people are excited about it. I don't think this is the magic piece that people are thinking of it. Let me know in the comments below, and we'll see you on the next video.